Imagine this. You're invested in a stock or a fund, and its value has plummeted to half of what it was worth a year ago, with no end in sight. You hate to lose money. Should you sell to prevent further loss? Or perhaps the market's been rising and you are wondering whether you are missing the boat and should be owning the current winner. These are examples of trying to beat the market using timing. It's a loser's game. It's at least very difficult, if not impossible, to succeed at market timing over the long run. Turns out that most investor money flows into stock funds after good performance and goes out when bad performance follows. Investors chasing performance are always too late. For a recent 25-year period, John Bogle found that the vast majority of investors earned 5% less than the overall stock market return. Over half of this gap was from market timing, the rest from unnecessary costs. It's simple to achieve the market return because you can buy a single mutual fund that owns all publicly held companies for a low cost. But it's only easy if you have a plan that matches your ability, willingness, and need to take risk, and then you stick to it and weather all the sales efforts that are targeted at you. To make money from stocks and bonds, it is important to acknowledge that you are investing in companies, either by becoming a lender to them through holding a company's bond, or by becoming a partner with them through buying a company's stock. We collectively buy and hold these shares for the long term, sharing the wealth all these companies generate through their growth, resourcefulness, and innovation. And we collectively all earn the market return. But within this pool of shareholders, there is short-term trading between investors. And for every person that beats the market return, there is an equal and opposite loser. The huge financial services industry is very adept at convincing you that they can help you get better returns than the market, so that you'll watch their channel, purchase their newsletter, or invest in their fund. My next video will help you distinguish a good fund from a lousy one. Attempting to predict the future direction of the market is only the first of two common timing mistakes. It's also incredibly tempting to invest in the most recent top-performing categories of stocks and bonds. Last year, the best performing investments were the category of stocks known as small cap growth, followed by real estate companies, and so forth, down to international stocks and finally bonds. Predictions here are futile. Here's where last year's top performer was in previous years. Here's where last year's second best category was in previous years. You get the idea. John Bogle warns, don't think you know more than the market. Nobody does. The other common mistake is to invest in yesterday's top performers. Winning strategies buy and hold a portion of all the nation's publicly held businesses at a very low cost. By doing so, you are guaranteed to capture almost the entire return they generate in the form of dividends and earnings growth. Here's a short example. Henry is saving for his retirement in 30 years. He chooses to own his age in bonds, which means this year 35% of his retirement savings are allocated to bonds and 65% are allocated to a fund that owns the entire stock market. He rebalances every birthday so that gradually his percentage of bonds increases. Now, does he hesitate after every paycheck and consider whether stocks might be cheaper to buy tomorrow? No. He sets up his purchases to occur automatically and avoids that first timing mistake. Does he ever consider which companies or mutual funds are doing the best this month? Nope. By simply buying a small piece of the whole market, he gets to own them all and avoids that second timing mistake. How about rebalancing every birthday? Is that market timing? No, again. It's an example of having a plan and sticking to it. Find other explanatory videos, smart tips, and links to useful resources at financinglife.org.